Hello. Welcome back to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. The market has been quiet for us the last few days. I think today is a great opportunity to zoom out, take a step back, and see how we got to where we are today. Let's look at the last year or so of the market and see what has evolved and how we can use that information to inform our expectations coming into 2022. Hope you're ready to do a little bit of a year in review. It certainly won't be exhaustive. We won't look at everything that changed over 2021, but I'll talk about a couple of the key narratives that I think are important to keep in mind as we go into the new year. If you enjoy my content, please give this video a thumbs up and subscribe to my channel. If you hit that bell icon, you'll be alerted to all of my new videos the moment they arrive. So let's talk Bitcoin. So here's our price chart. It's been downright boring. And as we laid out at the beginning of December following this liquidation, we've continued to chop and range in this very small zone. There was some excitement on Christmas Eve when it looked like maybe we would finally break out of the high end of this range, but no. And so now we find price down here battling with some of these shorter term trend lines. This is the price action we expected this month, but seeing it play out as we expected doesn't make it any less boring. If we flip over here to the daily chart, we can see price is really solidly trapped here between the 200-day and 50-week moving averages at the bottom and the 21-week exponential moving average at the top, which is another really popular moving average. Price is just stuck in here. It just can't seem to get out. And who knows, maybe we keep going like this while these moving averages converge into an apex, and that might be what gives us the volatility to go one way or the other. We may also start getting some news stories in January that give the market some more energy. Or who knows, maybe just the existence of fresh P&Ls will be enough to awaken some of the energy in this market. Whatever it is, things are very quiet right now. If I show you our derivatives dashboard, which covers the futures market that we look at so often, we can see open interest, the value of contracts in futures, is still rising, but the funding rate is staying about where it was, and it isn't yet belying any clear bias. There are obviously some longs in the market and some shorts. And if price is going to allow all of these participants to stay in their positions by way of sideways price action, then there's no reason for any of this open interest to be closed out. So while we're seeing boring price action and we're seeing the futures market kind of standing on a cliff here with OI rising into sideways price action and the funding rate staying sideways, staying horizontal, this isn't the area that I'd like to focus on today. A quick move in either direction will see some liquidations, as we've noticed in the last few days here. We've got long liquidations on the way down and a couple of shorts on the way up. But what I would really like to look at today is what the Bitcoin market experienced throughout 2021. I want to zoom out a bit, look at some of the bigger events that occurred on chain, some of the dynamics we observed throughout the year, which I think will help give us a good baseline going into 2022, because it's really important that we understand our history in order to better anticipate the future. So what I first want to look at is the effect of Grayscale on the market coming into 2021. So the Grayscale Bitcoin Trust is a large custodian in the Bitcoin space. Basically how it works, you buy into the GBTC trust. You give them your money, they buy spot Bitcoin, and you are given shares of GBTC. Those shares have a market price, and their price per share has a variable in relation to the price per unit of Bitcoin. So savvy arbitrage traders coming into this year were playing the premium between the cost to buy GBTC and the eventual sale price of those shares after their unlock period expires. Because once you buy into Grayscale, you're required to keep your shares there for a period of time before you're allowed to sell them on the other end. But the important thing to know about Grayscale is that when you buy into it, they buy spot Bitcoin and you are given shares of the trust. It's like shares of stock. And when your unlock date arrives months later, you are able to sell those GBTC shares onto the open market. But the difference between them and spot Bitcoin is that you aren't selling any Bitcoin. In fact, when you are a member of GBTC, you don't own any Bitcoin. You own shares of their trust. So buying into Grayscale has a very bullish effect on chain because it then leads to Grayscale acquiring more spot Bitcoin for their trust holdings. But the unlocks on the other side, the sale by users out of Grayscale, does not affect spot Bitcoin as much. It mostly affects the actual stock market price of the GBTC ticker. So it's a really cool mechanism that helped to drive a lot of the price action we saw last year. That price action is represented up here in this blue chart. These big bursts of blue on this area chart represent the 30-day change of Grayscale's Bitcoin holdings. So when you see these large inflows, that is because investors are buying into Grayscale, and Grayscale is acquiring spot Bitcoin. And the reason that they saw such heavy inflows last year is because of the premium I mentioned, because of the arbitrage opportunity between buying into Grayscale at a premium to the spot price and then later collecting on that premium when you can sell out of your GBTC shares. The Grayscale premium is this second chart here. And if you'll notice, it was positive for much of 2020 and coming into the beginning of 2021. And curiously, the Grayscale arbitrage itself, the inflows of Grayscale, were very heavy up until the point that the premium began to dry up. You see the decline of these green bars down to even and then eventually going red. This is the Grayscale premium drying up. And it was around February 22nd, for the first time, it fell below zero, which meant that it was no longer profitable to trade the arbitrage between spot Bitcoin and the Grayscale trust. Leading up to this moment, the amount of money flowing into Grayscale was exorbitant. Their holdings grew from around 380,000 Bitcoin all the way up to over 650,000 Bitcoin in this period of time here, nearly doubling. And as of this time of recording, there are still over 650,000 Bitcoin in Grayscale's possession. But the arbitrage trade that was helping to drive a lot of the inflows, which also occurred during the height of the bull run in 2020 and 21, that premium is now gone, and it has been gone since February. The inflows to Grayscale dried up when the premium dried up. These two events happened in early February when the fun part of the bull run had mostly completed, which leads me to conclude that the Grayscale arbitrage was a huge factor in why price was able to rip from 10,000 all the way up to 40K in a couple of months. It was led largely by this aggressive premium arbitrage trade, which saw 300,000 Bitcoin pumped into Grayscale's possession. And there's always a lot of talk about how whales drive the market and how whales put the top in. And if you look at other whale activity, so non-Grayscale whale activity, it's represented here in red, and it is a fraction of the activity that Grayscale contributed on chain last year. I mean, just look at the disparity between the change in Grayscale and the change in these other whale supply. Now you can see here in November through into early January, whales had a bit of distribution, so there's a little bit of selling from this group. But their real capitulative exits from the market didn't seem to occur until a couple of months later, back over here in February and then March, right around the time that the Grayscale ARB completely dried up. This also happened, this started winding down before the public found out that Tesla had Bitcoin on its balance sheet. That news story came out in early February, which I've marked here on this chart. And for much of 2021, many analysts kept talking about how Elon was responsible for much of what happened in the spring. And looking at this chart here, I do not believe that's the case. Most of the bull run and most of the aggressive growth in price occurred during the Grayscale arbitrage, as you can see back here. And it wasn't until February 8th, after the majority of this activity was over, that Tesla really entered the ring in the psyche of Bitcoin holders. But by this point, activity was already falling off on chain. And in a moment, I'll show you transactions and active entities that represent how much activity was declining after this point right here. And what really helped to carry the spring rally and create this kind of Bart Simpson zigzag price action was, as you can see at the very bottom here, high funding, high futures leverage. So this down here is the futures perpetual funding rate, which many of my viewers are familiar with at this point, and helps to represent the amount of bias and leverage in the futures market. And in the spring, starting in February and late January, the amount of leverage in futures was the highest it had ever been. And this was occurring while base layer on-chain activity was declining heavily. So if fewer and fewer spot traders and buyers of physical Bitcoin in the market, as more and more derivatives activity is taking over. And that creates a weakness in the market. It creates a lot of surface level activity, but underneath, the actual liquidity, the actual depth of the order books is not there to help sustain price movement. So what led to a lot of the chop from March and April and then into May were liquidations in futures from people getting overexposed to the long side and a bit to the short side. And these liquidations pulling price down and then shoving it back up and then pulling it down and then shoving it back up. And throughout this period, we saw some whale distribution, some of the larger holders on chain distributing a bit of their coins. But it wasn't really until mid-May when China banned Bitcoin mining that we actually saw the capitulation moment. That was the day when we finally got shoved. We had that huge liquidation that sent us down to 30K. That was right here. So the main takeaway from this chart that I want you to keep in your minds is that much of what propelled price a year ago was an arbitrage on the Grayscale trust that no longer exists. In fact, the premium is well into the negative now, and the interest in buying Grayscale is very low compared to where it was 12 months ago. Another factor that helped bring an end to the fun in the spring was the eventual capitulation of illiquid holders. So on this channel, we talk quite a bit about illiquid supply, and that supply represents HODLers who have a low history of spending. The majority of their on-chain activity are inflows, are the accumulation of Bitcoin. And when we see this group spending out of their supply, giving up their coins, it represents weakness in the market, particularly because illiquid supply takes up a very large percentage of Bitcoin. Illiquid supply, these HODLers that I'm talking about, are shown here on this blue chart at the middle of the screen. Their supply was increasing throughout the winter and spring months of the beginning of the year. And in mid-April, right at the top of the market was the Coinbase direct listing. And at this moment, illiquid supply started spending, and they consistently spent much of their supply into May, into this moment when China banned industrial mining, and then they, along with the rest of the market, had a capitulation. But illiquid holders sold the Coinbase direct listing. They sold the news. And then in May, after the liquidation and the full wipeout of futures, illiquid supply was one of the first groups to stop spending and start slowly accumulating once more. So this group, coming into the end of 2021, has maintained this aggressive accumulation behavior. You can see it's continuing to ramp up, and they've almost reached back to the same amount of supply they had in April. For me, this view of illiquid supply is one of the core foundations for why we've felt bullishly about Bitcoin throughout 2021. Illiquid holders have over 70% of Bitcoin, and they represent a certain type of investor that it's very important to understand the sentiment of. We've spoken a lot on this channel about how short-term price action is heavily influenced by derivatives, by spot markets, by order books, by technical factors in the moment, right? Those things are what can lead to a liquidation cascade, to a dramatic sell-off like we had on December 4th. And those are the headlines that the casual investor hears about. But underneath the hood, when we see that kind of weakness, where I look is at the HODLers themselves, at the people holding Bitcoin, and whether or not their behaviors have changed as a result of those surface level news events and those surface level technical changes. And for me, as we enter 2022, well, it's clear that the derivatives market has grown a lot and plays a heavy role at times in price. As long as we continue to see illiquid holders accumulating more of their supply and not exhibiting this behavior where they spent in April and May, then I am confidently maintaining a broad bull narrative for Bitcoin. It is challenging to present a cogent narrative that Bitcoin is about to plummet plummet into a long bear market when the people who have the majority of the supply are not spending it onto the market. What causes prolonged negative price action is when there are more sellers than buyers, is when there is more available supply than demand to acquire that supply, right? Well, this group, which has 70% of Bitcoin, is still acquiring more of it. And while it's very possible we could see price weakness in a single day if a liquidation cascade occurs like it did a month ago, it's very reasonable to assume that a short period of time later, price would have recovered as this group continues to accumulate that supply. The constant buy pressure of the dollar cost averagers will eventually soak up whatever supply is temporarily dropped onto the market. That is my core belief at this time. Another thing about illiquid supply that I've found quite interesting is the amount of it that they have spent this year. So what I've put on the screen here is something I'm calling illiquid value flow. What this represents is the 30-day dollar value of illiquid supply change as a percentage of the market cap. So when you look at illiquid supply in Bitcoin terms, the value of those coins is different at different points in time because of the nature of Bitcoin's price. So what I decided to do was look at the amount of dollar realization happening for this group in relation to the total market capitalization of Bitcoin at that time. So it's a way of looking at relative profit realization by a specific cohort that matches the value of the network at the time rather than a fixed dollar amount. So what I see here when I compare the current market to 2017, 2018 is considerably less spending by illiquid supply types. So as we reached the market peak in late 2017, illiquid supply spending was about 0.05% of the market cap on a 30-day basis. You see here this big red burst. This is a lot of selling by illiquid supply. They are spending their coins out of their own possession into the possession of more liquid entities. They could be exchanges, they could be traders, they could be weak hands. And in the weeks and months following the eventual rollover of price, illiquid supply continued to be spent out of this group all the way until the actual bottom fell out in November of 2018 when they spent once more. In fact, the entire market spent here. This was a big capitulation. But even the months prior to that, look how much more spending is occurring out of illiquid hands. And then feast your eyes on the 2021 market. Note how this period here from April to May was the only period of the year where illiquid supply was consistently spending. And in the weeks and months since, they've actually been growing their stacks. They've been buying at a consistent clip to where they have been for the last 2 years as a percentage of market cap. Back here, price was only $10,000, not $48,000, but as a percentage of market cap, illiquid supply was still buying back here just as aggressively as they are now. I find this to be very remarkable. And when I see this dynamic here where it looks like there's almost no weakness at all amongst illiquid supply types, that's what I see here. I don't see this where every few months they find an excuse to spend more of their coins. There was one quick burst and then it was over. It was really just like this moment here. And we never got the suckers rally where there was another wipeout. It was immediately reversed into buying. Their rate of purchase has been increasing the last few months. You can see that, higher highs. So the 30-day flow of value to illiquid hands is showing a lot of confident accumulation. And when I look at the previous bear market, it doesn't resemble it in much fashion at all. So I mentioned earlier in the video that I would show you network activity, and there are a couple of observations I want to point out about this chart. What we're looking at here are active entities, that's in the blue line here, which are individual participants on chain, and the orange line represents their transactions, the individual count of transactions for each of these entities in the blue line. Last year and entering the beginning of this year, there was a sharp increase in active entities on chain and a modest increase in transaction counts. And all of these values peaked early in the year, right after this initial run up to 40K, and then the pullback in January. This was after the doubling of the previous all-time high at 19,500. We ripped up to 40. We have a pullback, and this moment here, as we've spoken about in the past, was the true market top in on-chain terms. This was where we saw a lot of spending of older coins, and in the wake of this moment, precipitous fall in activity. If I switch over here and show you the realized cap HODL waves, which is the distribution of all supply weighted by their on-chain value, you can even see the activity falling off in the same way here. Whereas this chart is showing active entities on chain and active transaction counts. This over here is the actual distribution of supply. And when we see these big bumps in these hotter colors, those are coins being spent from older groups and their lifespans being reset. Well, look at the spike here. It's at this moment. And in the weeks and months following, it declined. It did not continue into February and March and April. This was not a bull market any longer. The bull market ended back here. And the reason we were able to continue bouncing around, as I discussed earlier, is because of this funding down here, is because of the extremely high leverage in futures and the corresponding high open interest. Because activity itself, spending activity, was heavily declining. And when you see these groups expanding, these higher groups expanding and belling out and then eventually smoothing as the group above them expands, coins are maturing upwards and to the right through these groups in the wake of the spending that occurred at the beginning of the year. And so all these activity measurements fell off, and they've slowly been rising since the summer, no doubt. But if I zoom out my chart, these levels of activity are much closer to this mid-cycle run in 2019 than they are to what we experienced at the beginning of the year. These levels of entities and transactions are much closer to what we have now than anything we saw 12 months ago. So what this really tells me about the current market, we could call it bull market, bear market, say whatever you will. I think those words can give the wrong impression. It's clear there was a bullish market dynamic at the end of the year, right? That's what gives you price action like this. A lot of supply was dumped onto the market, and it took time to accumulate. Activity was already falling off, which means that there were less and less people on chain each day to accumulate said supply. Then we reach May, China bans industrial mining, and all of that leverage that was built up in the system throughout these months gets squeezed out at once. Whoosh! The whole market collapses. That's how we get a major liquidation event that drops price 54%. And in the weeks and months following that event, we crept all the way back up to new all-time highs, solely because of a lack of spending, because of a lack of sell pressure. Whatever retail demand may have been represented here, I don't believe A was as strong as people think it was. I don't believe that Tesla and Elon Musk had much to do with this at all, as we explored earlier. And since this moment, since this period at the beginning of the year, they have not been present in the market at all. There has been little to zero casual retail demand. And the only reason Bitcoin created all-time highs in October and November were because of a derivatives squeeze in July that helped push us out of the summer lows. There was a short squeeze here that we've explored on this channel. And then accumulation behavior dominated all the way up. Strong hands, illiquid types, our homies right here buying up coins. That's why we got all the way back up to all-time highs. Because rather than spending as they did repeatedly in the wake of the 2017 top, this spending wasn't there. It was all buying. And simple market dynamics dictate that when there are no sellers and everyone is a buyer, price will go up. So as we come into 2022, one of the first things we need to see established is for the shorter term hands in the market to find themselves back into profitability. I'm talking about the short-term holder cost basis, which currently sits around 51,500, down from its 53,000 level a couple of weeks ago. And for the time being, short-term holders are underwater. They represent the newest buyers, they represent the weakest hands, and they've been dealing with loss since early December. So before we can anticipate new bullish price action, it's likely important that some of the newest buyers of Bitcoin find themselves back in the green, or at the very least, market neutral. So short term, that's the next goal post from an on-chain perspective. But as we explored with illiquid supply, seeing this continue to grow gives me confidence that the market is not ready to roll over anytime soon, regardless of what's going on with macro. We could see short-term weakness as we've explored, but then this dynamic will step in and set the floor. We can even see some of this accumulation behavior in the change for long-term holders. So while illiquid supply is based on the in and outflows of an entity, long-term holder supply is based on how long they've held their coins. This group was a big spender in December and January. You can see here, this is the 14-day change of long-term holder supply. And from October through February, this group was heavily spending out of their own hands and into short-term hands. That's what this big negative spike is. Then they entered accumulation throughout the summer, and as we approached the previous all-time high, they did spend again. But note the limited spending of this group. It's only about a third of the velocity of the spending from a few months prior. It's almost like they didn't have enough time to reset their desire to exit. And now in the last few days, they're even accumulating again. Maturity has returned to this group in the aggregate. And the reason it's important for illiquid supply types and long-term holders to continue adding to their stacks as a way of determining market sentiment is because they own far and away more supply than any other cohorts. There is a lot of overlap between long-term holders and illiquid types, but they're not an exact one-to-one. Illiquid supply owns 76% of all Bitcoin, and long-term holders own almost 71% of all Bitcoin. All other groups, highly liquid, short-term holders, exchanges, miners, etc., all own no more than 17% of the remaining supply. So HODLers are the ones to watch. They have the biggest impact on market dynamics when they choose to, and they own the largest portion of circulating supply. But as we explored, the HODLers themselves are adding to their portfolios throughout the last couple of months. And as we head into 2022, I expect this dynamic to continue. Now, if price were to reverse and suddenly skyrocket back up to about 70K, I anticipate we will start to see more spending out of this long-term holder group. But what will be important to watch is how much they spend in relation to the past and at what point they begin accumulating again. Will they dump so much supply onto the market that it takes months to recover? Or will it be an aggressive V-bottom like we had in March? Who knows what the next drawdown will look like? But as long as supply continues to be restricted, as long as we see exchanges continue to own less of the supply as they have, down about 3% year to date so far. If they continue to lose supply to stronger hands, then we will eventually have a supply squeeze in play. I do find it curious that exchange balance is down 2.8% this year, but illiquid supply is up 3%. Calling a supply squeeze does not mean that price will immediately react. What it does mean is that the ingredients are laid out for the market to react positively to a spike in demand, and seeing the continual growth of illiquid supply alongside the continual downtrend of highly liquid supply, which contains exchanges and traders and weak-handed investors. Seeing these two things diverging from each other at the same time as we are seeing now net accumulation by long-term holders and relatively quiet on-chain activity coming into the end of the year, it really feels that we're setting up for another squeeze type of scenario. All it takes is for a little match of demand to be thrown on the floor, and all of this supply restrictive kindling will catch fire. There's a lot of things out there to be uncertain about, a lot of macro headwinds, but one thing that is not changing is the core operational thesis of Bitcoin itself. When you see all of this price volatility, when you see uncertainty, when it feels like the market is about to roll over on its head, take a step back, look at the data itself, and decide where the volatility is coming from. Much of the time, it's coming from the denominator we value the price in, which is the US dollar, not the Bitcoin numerator. The world around Bitcoin is volatile and uncertain, and as this asset continues to be adopted by more and more people, it will also experience a roller coaster of ups and downs. But proof of work issuance, the dynamic difficulty adjustment, the 21 million hard cap, all of these things are what make Bitcoin what it is, and none of them have changed. So while we might get a big liquidation now and then from the futures market, or some FUD coming out from mainstream media that don't understand what the asset even is, I like to go look at what the hodlers and the smart money are doing. And they are still accumulating Bitcoin like there's no tomorrow. The last time the market actually rolled over on itself in May was when those groups decided to spend their coins. And until I see that behavior, I will continue to expect medium to long-term healthy growth for Bitcoin. Make sure you're following me here on Twitter at TXMC Trades. You should know by now that I post a ton of charts and content on there, and it's a great place to ask questions and communicate. Today is New Year's Eve, so I hope you all have a party or some kind of event planned this evening to celebrate the new year. I look forward to many more discussions about Bitcoin in the months and years ahead, and I'm grateful to all of you for your support and for coming along with me on this journey. If you have any feedback for me, ideas for content, or you just want to say hello, leave it in the comments below and I'll be sure to read through all of them. We'll chat again in a few days. Take care of yourselves, friends. Be kind to one another. Spend the evening with loved ones, and we will chat in 2022. Cheers, everyone.